everyone, and a very warm welcome. It has been just 4 months into calendar year 2022, and we have witnessed a plethora of events. We have seen geopolitical tensions, a hostile takeover, changing global models of trade, and inflation in the developed world being higher than that in India. The government securities in the world have been more volatile than equities. If this was not enough, we have seen Netflix fall 35% in a single trading session, whereas Indian movies have been garnering a business of rupees 100 crores in a single day. How do we read these situations? What do these events mean for India? To discuss this and more, I am joined by Mr. Vetri Subramaniam. He needs no introduction. He's a market veteran with over 3 decades of experience. And I am Bangalore alumnus. He is the Chief Investment Officer at UTI Mutual Fund. Thank you, sir, for joining in. It's a pleasure to have you back with us.
Thank you, Megha. Thank you, Harsh. Pleasure to be here.
So let me begin a situation of global macros into perspective first. If we see the yield curve in the US, it is inverted. If we see the negative yielding debt globally, it has come down to $3 trillion from about $18 trillion. There has been correction not only in the tech stocks in the US, but also in the cryptocurrencies. The gap between the US and Chinese 10-year bonds is been narrowing down. We have understood that we need to fall back to conventional sources of energy. Yes, as a pack has underperformed. So, as a seasoned market veteran, what do you make out of this situation? And do you think that investors can use it to their advantage?
Sure. No, thank you, Megha. That's a pretty thoughtful and also a pretty powerful question. I think policymakers would currently feel that the old, sort of proverb, be careful what you wish for because you might get it, is actually ringing true in their ears right now, right? Because for the last almost decade, they have been trying to create inflation. They've been hoping for inflation, and it never came about, right? And now suddenly, when perhaps till even 8 months ago, they thought inflation was transient and they still had to create inflation. Suddenly the tables have turned and they have gone back to the textbook of not 10 years ago, but maybe 25 or 30 years ago, where you suddenly realize that this inflation monster is now out of the bottle and you've got to figure a way to put it back in the bottle, right? There's only one thing that I think, not good news, but at least I think one can warrant that central bankers and governments across the world still have a much better understanding of how to tackle inflation than they have the ability to tackle deflation. So in a sense, the policy prescriptions for what to do when you face inflation are reasonably well known. I think particularly in the US, right, you mentioned the yield curve. I think the US has now, the Federal Reserve has taken the plunge in terms of saying the economy is hotter than they are comfortable with. Remember, they have a dual mandate, inflation and full employment. They have certainly got full employment. They are in fact saying it is unsustainably hot, the employment market. And inflation, of course, as you know, 40-year high. So I think they are now very, very clear that they need to get supply demand back in balance, which is a central bank way of saying demand is too hot, we need to push demand down, right? So I think the whole tool of policy settings to achieve that is now being rolled out. It's being rolled out not only in the US, but gradually it is coming to most geographies, right? Even though the settings may not be identical. For example, in India, we have high inflation, though as you pointed out, it's actually lower than the US. But clearly, we don't have an economy at full employment, but we have no option but to deal with the inflation challenge. I think the only economy in the world, the major economy in the world, which is sort of dealing with currently a issue of trying to loosen is China. So as you rightly said, it's a very complex environment. There are many moving parts, but as an equity investor, I think the most critical aspect you need to keep in mind is that when rates go up, right, those rates will impact the cash flows of company, because eventually an equity stock price is nothing but the value of cash flows that that company will earn over the next 5, 10, 15, 20 years. If the discounting rate on that goes up, then there will be some impact on the valuation of that equity. You rightly pointed to cryptocurrency. See, assets which don't generate cash flow get the most impacted, right? So that is why they've been the most impacted. A lot of the tech space is again impacted because they were the companies in which you were discounting cash flow 20, 30, 40 years out into the future. And as you come to companies where you are not discounting cash flow so far into the future, they've been less impacted. But I think the thing that we need to worry about is that if the US Federal Reserve is clear about pushing demand down, this will have a negative impact across the world. And we are simultaneously dealing with the fact that China has this entire COVID zero policy, which is unfortunately both a disruption of supply chain. Simultaneously, it is actually reducing demand across the world, because please remember, China is the world's second largest importer, right? So if China goes into a lockdown, demand for goods from the rest of the world comes down, because this is the world's second largest economy and the world's second largest importer. So I think we're dealing with a complex scenario. As the price of capital goes up, as there is some potential risk to earnings, there is eventually, in my mind, Mega, only one template for equities. That is not economics, that is valuation. The reality is that valuations were in the expensive territory. As we see the market go nowhere, it's gone nowhere for 7, 8 months. Some earnings have come through. The market is starting to derate. I don't think that process is complete as yet.
That's a cautious note coming in. So coming back to, Indian markets, it has been a little different year of sorts for India, because we're kind of expecting India to grow at almost double the rate than that of China. If I look at the gross tax collections, we have almost 27 lakh crores against an estimate of about 22 lakh crores. Our merchandise and service exports is at an all-time high. If you look at the goodwill India has created by first exporting vaccines to the world, and which is now getting cemented by the export of wheat right now, we've been able to, kind of import crude at a discount from Russia. So, in the light of all this, how do you see India at this point in time?
Oh, I think if you wanted to be the citizen of any country at this point of time, you should choose to be an Indian citizen, right? For all the reasons that you mentioned. But what does that have to do with investing in equity, right? See, I think when it comes to equity, we have to be very clear. Every stock price implies a certain expectation of growth, return on capital, and so on and so forth about what will happen in the future. The odds of getting a superior return in equities improves when the expectations are depressed and you are paying a fair price for it. If the expectations of a superior outcome are already discounted in the stock price, it is very hard for you to get anything significant out of it. So we are not discussing whether you should choose to be an Indian citizen or otherwise. There's no two arguments about that. But what we are saying is that when you come to the equity market, that logic doesn't work. You have to see what is the equity market discounting and what am I paying for it. If what you're paying for is significantly lower, right, than what is being discounted, then you have a significant advantage. So I think the challenge from the Indian equity market point of view is, just because we have a very strong platform, we certainly have one of the best and the strongest macroeconomic platforms I can recollect in almost 20, 25 years. It does not necessarily create the argument for returns. For returns to be good, I need the valuations to be attractive. I need the market to be a little bit pessimistic, right? Unfortunately, that is not the equation I am being served up with today. The market is still discounting 18% earnings growth in calendar 2000, in the financial year 2023. And I think there are some question marks about two things: the impact on profits because of pressure on margins, the impact of reduced demand because of the way commodity prices in general have moved higher, because it has an impact on people's ability to consume. So I think these are some things that I worry about, that we've sort of discounted very healthy growth prospects. We'll still do significantly better than many other parts of the world in terms of growth, but I would be happier to increase my allocation to equities when the expectations of what companies can earn are slightly more pessimistic. Today, they are still quite optimistic.
Right, sir. My next question was coincidentally on the earnings. And as you rightly said, we're expecting a Nifty profit growth of around 18% and a Nifty EPS of around 880 rupees a share. Now, from the time I've been tracking markets, we've been having overly optimistic, a view on how the earnings for the next financial year is going to be like. While discounting what is going to happen in the next 2 to 3 years, how do you see earnings for Indian companies over the longer period in time? Because ultimately, that is fundamental to how the returns will generate in the market.
Well, that's a very interesting question, Megha. And given the gray hair you can see on me, I've seen a lot of these cycles, and I've seen extreme cycles of analyst optimism. But believe me, there are also periods of pessimism. And I'll just take you back to August 2003, and I'm sure in my cupboard I still have a report from August 2003, where one of the brokers, we shouldn't take names here, everybody's guilty of the same things, right? Actually has a report in August 2003 saying, yes, we know last year earnings grew 24-25%, but next year they're only growing to go 8%, right? Now, if you see the reality of what happened between August 2003 and March of 2008, we got 5 years of earnings growth of 25%. But nobody could see that in August 2003. And it goes back to the point I made, Megha. In August 2003, the expectation was actually quite pessimistic. And because it was pessimistic, you got this bump when reality turned out to be so much better. I think that's the headwind we are running into today in terms of expectation. As regards that 18%, I think there are issues with that 18% for two reasons. One, as I said, there is going to be some demand compression. Last week, in fact, just last Friday, we were meeting one of India's largest steel companies. He said, everything is great, I'm making a lot of money, but at these steel prices, I am worrying that my customers will start cooling off in terms of their demand, because there is only so much you can pass on to the consumer, right? You can't hike the price of a car or a refrigerator saying every single paisa of cost increase I will pass to the consumer. People will pull back saying, I can't afford to consume at these prices. So I think there is a potential for demand to surprise negatively, in addition to the fact that the margins are going to come under risk if these commodity prices stay elevated. Now, there is a big question mark over here, Megha. Remember, we are now currently dealing with a set of prices which suddenly went askew in the month of February, March, when this whole Russia-Ukraine conflict started. But the challenge is that as long as it persists, and I don't think there's anybody who could accurately forecast when it started, I don't think you can forecast when it will end, this problem will persist. And as long as it persists, those earnings forecasts of 18% will run into challenges. So I would tend to agree with you that 18% is a low confidence forecast, with one caveat, right? The caveat is this: even if we get close to 18%, it's going to be because of the profitability of certain of these commodity heavy companies rather than the typical consuming companies. The challenge with that is that the market does not pay the same multiple for those profits, right? So there are two issues. Can you get to 18? It looks difficult. You might fall a little bit short of 18, but the quality of those profits might be a bit adverse, which again creates issues for the construct of the indices and the way companies are reflected in them. So I think there are some challenges in achieving that 18%, and I share your concern about the ability for those numbers to be true.
Right, sir. I think, the point further gets re-emphasized that good news and good returns don't come together. It is only in terms of pessimism that we expect the markets to do better. This is something we keep reiterating to all our investors.
No, 100%. I mean, the reality of investing is that the bad news and cheap valuations come together. The good news and rich valuations also come together. So unfortunately, the investors have to, I always give this example, you know, when there is a fire in a building, the natural reaction for you and me should be to run out of the building, correct? Now, there is only one individual who runs towards the building, and that is a fireman, right? Not all of us can be firemen, but if you can be a fireman, then you would have built into your sort of armory a better tool to deal with volatility of markets than any understanding of underlying economics will give you, right? Good investing has nothing to do with understanding economics. It has little bit to do with understanding good businesses. It has everything to do with behavior.
Right, sir. I think that's another area of discussion altogether, and we hope we can kind of help our investors understand the various dynamics of investor behavior. Coming back to FI outflows, which have remained a big pillar of supporting Indian markets. If I see the period from October 2021 to 31st March 2022, we have seen an outflow of almost 1.5 lakh crores. But unlike the previous times, we have seen a drawdown of only around 14 to 15%. Uh, does this mean that the domestic institutional investors and retail participation is kind of covering up for the FIs, and FIs are kind of losing their relative importance? In fact, the Honorable Finance Minister had made a statement on 4th of April 2022 when she said that it is the retail investors who hold the market. Would you have the same view?
See, I think this is a very emotional issue for many people. I must tell you that my experience of 30 years in the market, foreigners have been more consistent, more persistent buyers of Indian equities than Indian investors. That's the harsh reality. You can talk about the last 18 months, but 24 years, 30 years of history, foreigners started coming in 1993. If I remember the data from 1993 till 2020, so roughly 27 years, there are only 4 years in which foreigners took money out of the market. All the other years, it was the locals taking money out of the market. So let's first give them some credit that they've been long-term investors and they're not really fly-by-night operators. I think the second issue that we need to sort of keep in mind is, why do we buy equities? We buy equities because there are good businessmen who hopefully will be able to generate earnings. They will be able to generate profits. They will be able to reinvest those profits in their businesses, and therefore, the whole virtuous cycle continues. That is why primarily the stock market exists. It is a market for capital for the underlying businesses. The minute Mega and Hertz should get into this discussion about flows, right, you are losing sight of the reality. Because the reality is that stock market outcomes are eventually determined by the earnings capabilities of companies and the quality of managements that manage them, right? It has very little to do with the color of the person buying or selling the stock. That's my simple point. Now, having said that, if you were to ask me what is a healthy stock market is one in which there is a balance of forces, not in the sense of foreign versus local, but people with very different, or let us say heterogeneous approaches. We don't want everybody in the market to be operating with one thought process. We want somebody to be value oriented. We want somebody to be growth oriented. We want somebody who thinks asset allocation. We want somebody who thinks stock selection. We want somebody who buys and sells 100 times a day. We want somebody who buys once and sells only once in his lifetime. When you have a heterogeneity of opinions, the market is a much better marketplace. So from that point of view, I welcome the fact that there is more local money relative to the foreign money. It makes the market slightly more heterogeneous, which is a good thing. But that doesn't necessarily mean that should be the basis of our buying or selling decisions. The basics of our buying and selling decisions should always be valuation. So I will not argue that we should be happy with an overvalued market just because locals are buying from foreigners at that point of time. No, I think what the locals are doing, and doing very intelligently, is buying through SIPs, right? Because if you're buying through SIPs, you are buying through the full valuation cycle. And as you buy through the full valuation cycle, your average valuation at which you get into equities will be in line with the long-term average. And that is a good strategy to use. In effect, it forces you to be a fireman, because you will also buy when the news is bad and valuations are very cheap. So I welcome the fact that the money is coming through SIP, but I think we should not make this a foreign versus local debate, because I think then you're losing sight of why the stock market exists. Never lose sight of that. It is the marketplace for transfer of ownership for the value created by businesses. If you disconnect the transactions in the stock market from the underlying value of the businesses, it's called a Ponzi scheme. And I don't believe the stock market is a Ponzi scheme. So therefore, my prism for looking at the market is always earnings. It is not who's buying or who's selling. I don't care who's buying or who's selling.
It's a very valid point. I think the problem with a lot of countries who were erstwhile colonized countries, they have a fascination with foreigners. While my father's generation was fascinated with foreign products, we are fascinated with foreign investors. And I think the next generation will have enough confidence to think that they don't care about foreigners beyond a point. So my next question is about an event which is very important in the current times. And I have heard you time and again saying that events are just transient in the market and they don't have permanent impact. But this is about Ukraine and Russia I'm asking about, because a lot of investors have concerns. When this escalation started, most of the world said that it would end before it's going to start, but that is not the case, which we are seeing at this point of time. And we also do understand, sir, that like any event, the impact is also not homogeneous across the world this time around also. While on one hand, we have countries like Egypt, Turkey, Italy, which are on the losing side because of various reasons, then we have also countries which have taken advantage of this situation. For example, countries like Australia, Canada, Japan to some extent. Now, in India, we have certain pros and cons. I mean, if I just be a little disassociated from the human loss of the war, while we are losing on fertilizer import, we are losing on crude oil import, we are gaining on wheat exports, which is not covering up for the first two things, but it's still trying its effort to do something. Now, how do you read this war, if it continues for a longer period of time, impacting India from an investment point of view and from an economic point of view?
So, I think context is always very important, right? If you were to ask somebody, chai kaise banti hai? I mean, how do you make tea? They would say you take the tea leaves and you put it in the water, right? But what this misses is the initial conditions. If you really want the tea to get made, the water has to be boiling, right? Only then when you put that tea in the water, do you really start to talk about making a good cup of chai, right? Now, unfortunately, people use only one-dimensional thought processes. There is water, you put tea leaves in it, so you get tea. They are forgetting the initial condition. The initial condition is the water should be boiling, right? Now, when you think about it in the context that you described of what's happening in the context of Russia, Ukraine, think back 30 years when the Iraq war happened, and it was a full-blown crisis for India, right? A year after the Iraq invasion of Kuwait is when India landed up in front of the IMF for a bailout, correct? So we have these very bad memories, oil prices go up, India crisis. It's not happening this time. Why is it not happening? Because the initial conditions are so different. Today you have, even after some outflows, you have $600 billion of foreign exchange reserves, pretty much equal to 12 months of imports. You did not have this kind of comfort, 30 years ago. You did not have this kind of comfort in the taper tantrum of May 2013 when your foreign exchange reserves had come down to about 6 months of imports. Your current account deficit, even after accounting for the increase in oil prices, is running at worst case 3%, right? Compared to the RBI's comfort level historically articulated of 2%. When 2013 taper tantrum happened, you were actually running at a current account deficit which was already closer to 5%. So point number one in the context of Russia, Ukraine, you are absolutely right. It's a humanitarian tragedy. There is a significant economic cost that everybody is incurring beyond, out of this. I don't think there are any winners. You mentioned Australia. I don't think even they are a winner because, they are getting impacted in terms of the stuff that they have to buy from the rest of the world. But I think the good news for India is that because the macro fundamentals are so strong, foreign exchange reserves, your inflation numbers, your current account deficit, your fiscal also sort of starting to heal. Megha mentioned the tax collections. So for the first time, you have the ability to absorb this shock, right? So I think point number one, investors need to keep in mind, we have the ability to absorb the shock. Now, which is the point in time you need to start saying, okay, here is an opportunity for me. I think that opportunity is when the valuations start to get attractive. To be very honest with you, we've been saying this for the last 2 months. The large cap valuations have started to drift into what I would call fair value. Not cheap, but at least in fair value. It's the mid and small pockets which are still a bit expensive. But coming back, therefore, to this whole Russia-Ukraine problem, nobody knows, Harsh, whether this will persist for 3 months, 6 months, 12 months. And therefore, we are not dealing with certainties. We are only dealing with probabilities. So we will also have to deal with those probabilities by saying, because we don't know for sure, we will have to design investment policies that are geared to deal with that uncertainty. What if the conflict persists for 3 more months? What if it persists for another 6 months? What if it persists for another 12 months? So I would say you will not get the answer to how will this resolve, because none of us know. I certainly don't know. I'm very clear about that. But I can deal with it in terms of the uncertainty risk. How do I deal with uncertainty in my portfolio? The quality of the business. Has it survived a difficult period before? What is its debt equity ratio? Can he manage his cash flow? What is his return on capital? Difficult times will come and go, but if the company has these fundamentals in place, when that Russia-Ukraine conflict goes onto the back burner or comes to an end and the world comes back to normal, the company knows how to put its foot on the accelerator and get moving again, right? If I was an investor, how do I deal with it? With my asset allocation, with my diversification of portfolio, with my diversification across geographies. So we have to use tactics to help us deal with the challenge rather than try to problem solve on which day will Russia-Ukraine conflict get resolved. If that is your starting point and question, there is no answer. If you are saying what are the tactics I can use to deal with this conflict, all of these tactics are available.
Got a point, sir. And I think it's not only relevant to Ukraine, Russia, but it is relevant to all the uncertainties. And you mentioned something that, when the times become normal, and there I would have a little contribute that times are never going to be normal, because in my investment career, I have never seen. So,
no, I completely agree with you. In fact, the sort of philosophical interpretation I have of this is that there is an average, there is a normal, but we are forever seeking normal. We are never at normal. So right. I completely echo what you are saying.
And so when we look at the past and we look at the present, we feel that maybe we are a little more normal than what we were 2 years back. And I'm hoping that 2 years from now, we compare on a relative scale and we find ourselves a little bit more normal from here also.
Absolutely, absolutely.
So, sir, my next couple of questions. So you have given us good perspective on equity market. And since a lot of our investors would be interested in non-equity asset classes also, so I'll take the liberty of asking you a couple of questions which are not directly related to equity. And though I know that that's not your primary area of expertise, but since we have your presence here, I'll ask those questions. So the first is about fixed income investors. Now, if we look at inflation trend in India, though you mentioned at the beginning that, we are still not in a zone, which is a worrisome zone. And we know that we are slightly above the mean and we can manage it, unlike the developed world where the inflation is 4-5x than what it used to be. We are just 1 or 2 percentage point higher than what it used to be in our case. Now, if you look at CPI, we are almost at 17-18 months high. If we look at WPI, we have been in double digit for almost a year now. If I look at the borrowing calendar for H1, it's at around 8,400 crore, which is not a 25% more than the last year, but it's almost double than what it used to be in pre-COVID times. So if I'm a fixed income investor who's looking for certainty of return, do I go by textbooks and invest into short maturity, target maturity bonds, or do I try to be adventurous and try to maximize my return? So what should be my approach?
So good question, Harsh. First of all, I should clarify that effective August 22, since I wear the hat of CIO, now I do look at all the asset classes in terms of,
Right. So I use the word primary area of expertise, but the reason why we kept this question is because we can take advantage of your wisdom.
Sure. So just to make 2 quick points on fixed income, look, I think the short-term rates will continue going up. I think RBI has, in a way, by stealth, already raised the policy rates. But I think there's no escaping the fact that the explicit policy rate will also have to go up, over the next 12 months. In fact, if you look at the market implied, right, we can calculate what is the market implying or expecting in terms of rate hikes over the next 12 to 18 months. The market is actually expecting the repo rate to go from 4% to maybe 5.5, 5.75. So that's actually quite a bit of journey that is already starting to get priced into the market when we look at the overnight index swaps. So point number one, the short term is going to go up. There is some value, therefore, in continuing to sort of focus at the short end of the market. And if the short-term rates go up, it doesn't matter because you are at the low end. But I think increasingly we are of the opinion that there is going to be an opportunity at the long end of the market in the next 6 to 12 months. It could come sooner in 6 months, or it may take 12 months to sort of play out. We can't time the exact point, but I think very simplistically, if we bring a thought process to fixed income, see, I think it's very clear that RBI is committed to this 4% plus or minus 2% band. We've even had some of the MPC members explicitly say that we are conscious of the obligation on the MPC that, we cannot allow the target to slip for more than 3 quarters. We will do what is necessary. So therefore, while they may have to take action at the short term, this should actually give investors confidence about the long-term trajectory of rates and inflation in India. So I don't want to say 7.5, I don't want to say 8, but I do think we are getting to that point where, if we were to anchor to that 10-year gilt, we are coming to a point in the next 6 to 12 months where it will be actually an opportunity to say that as the MPC has demonstrated its commitment to flexible inflation targeting at 4% plus or minus 2%, a 7.5%, 8% 10-year gilt is very inconsistent with a demonstrated commitment to that target. So I think there is an opportunity at the long end, which is going to come in the next 6 to 12 months. To get the benefit of that, you need to be at the short end today. So to that extent, I agree with the first part of your comment, but I do think you need to also prepare to jump in for the long term. I also want to make another point here, Harsh. We were discussing this internally the other day. You look at the last 1 year return on gilts, and obviously it looks terrible. But look at the last 10-year return on gilts. It's actually not a bad number considering it's a tax-free instrument in a sense, because if you just stayed invested in a gilt fund for 10 years, you don't pay tax on an annual basis. It's just continuing to compound. And the last 10-year history is a very healthy number in terms of the outcome. So I think we are getting up to one of those points where you could think about making asset allocation shift to long-term, long duration products on the fixed income side. And that opportunity will be there in the next 6 to 12 months. Also, gold, that's the other asset class that we look at internally. We run a multi-asset fund which sort of looks at a model to allocate to gold. So our gold allocation has actually climbed in the last 4 to 5 months. So gold also in that sense appearing to be attractive relative to its past relationship to other asset classes, particularly equities. So yeah, gold could also be a tactical investment right now. Also a good hedge against inflation, particularly if it sort of breaks out. So gold looking attractive, and fixed income, look out for long duration opportunities in the next 6 months.
The point well taken. In fact, for our investors who are not tracking yields on a regular basis, I must just inform them that, if you look at corporate bonds, if you look at PSU papers, if you look at state development loans, which are extremely safe categories, even in those, if you're looking at 7-8 years maturity at this point of time, the yield is upward of 7.1, 7.15, which is a very healthy way of looking at it. And you are right in saying that if you look at a longer period of time, say you mentioned 10 years, but if I look at last 25 years, the return of a government security and Nifty would converge at some point. So though equity fund managers would not prefer to be discussing this, but I feel that is a reality. And in fact, there have been a lot of studies which have been done by independent people on NPS allocation, because NPS primarily invest in government securities, and they have found that the returns has been really good on both the fronts if somebody went half G and half E, which is government securities, and half into equities. And so my next question is, like I mentioned, it's about non-equity, which is about gold. And you answered part of it that, you are tactically positive on gold. And the reason why I had question on gold was because of 2-3 reasons. One, Russia was denied a good part of its forex reserves. And that would invariably means that as a central banker, I would want to involve more of gold into my portfolio. than keeping, say, a dollar or a pound sterling or a euro. And second, like you mentioned, that inflation is back into the world after a very long period of time, without trying. And when we tried, we didn't get that. And third is that we are also seeing most of the developed world getting into a situation where their bonds are moving into a negative yields on inflation adjustment basis. So you mentioned that you are tactically positive. You are also strategically positive on gold. I mean, if I'm looking at gold, what should be my return expectation? And should I be looking at a more of a 8-10 years time view, or you are looking at only from a enter in now and an exit after 1 or 2 years?
I don't think I would have a view on an 8 to 10 year basis. I think that's slightly more tricky. But I think the setup is tactically quite positive, both in relationship of gold's relationship with asset prices historically. It's a good setup in terms of where we are in the inflation cycle. And the third part, which you mentioned as your first point, is actually the big unknown, right? Because what you have rightly pointed out is that what we saw this time in terms of how Russia found that, they believed they had $600 billion of foreign exchange reserves, but the weaponization of the financial system, which the West has, successfully used, must be causing policymakers, prime ministers, central bank governors all across the world to have a strategic conversation about, hold on, if we are holding foreign exchange reserves which are actually lying in the securities of a different country, how much protection does this give us? And is there a way to think differently about how we would like to hold these foreign exchange reserves? And I think some of that eventually does play once again to gold's advantage. It's got a historical track record of being a asset class in which you can store your money, and I think therefore all of that plays very much to gold's advantage. But as I said, the sort of time frame with which we view our gold asset allocation model is more a 1 to 2 year time frame rather than a 8 to 10 year time frame. But this whole issue of weaponization were to be seen to its logical conclusion, along with the fact that therefore the dollar would lose some of its role as the primary reserve currency of the world, it would also be structurally positive for the dollar in the medium to long term. And unfortunately, I have too much gray hair, but those who are younger would argue that some of these arguments would also therefore be in favor of the whole cryptocurrency universe. But I know very little about it, so I'm not going in that direction.
Got a point, sir. And I think the argument is very valid because there is one more advantage which our investors have if they invest into gold, that is dollarization of their assets. So if I want to send my children to US or some other country for education, I can buy their equities, or I can always buy gold, which is a globally traded commodity. So that brings us to the end of this discussion. And my last question is extremely important, because if we don't discuss the risk associated with the market, the discussion is never complete. Now, on one hand, we have rate of interest increasing, liquidity reducing in the system, central banker tapering. We might have another surge in COVID in India, and we are seeing good surge in a good part of the world, like you mentioned about China, and certain other countries are seeing that surge. We have geopolitical escalations. We have inflation, which is back in the world. We have margin compression, we have commodity prices going through the roof. So there are too many risks for a smaller mind like me to understand and read. So if I have to just focus on 1 or 2 key risks, or being a seasoned fund manager, what are the 1 or 2 risks which make you lose your sleep? And if those risks pan out, what is the kind of correction you see happening in Indian equity market? Are you expecting a crash? Are you expecting a moderate correction? So what is your view on these 2 points?
A good question, Harsh. You should never conclude any conversation without risk. But I have never lost my sleep over any risk. And I have said this publicly. Megha mentioned Netflix. The only thing which has made me lose sleep is Netflix, not market risk. So, see, market risk is omnipresent. You cannot run away from it, right? So, these days, of course, everybody has seen that Sony film on Harshad Mehta. And everybody knows that line, right? Risk hai to ishq hai. And that is true of equities. There will always be risk, right? You have to deal with that volatility which is associated with equities if you want the return. See, the biggest risks will be the risk that you are not even aware of, right? Neither did I know that a pandemic was a possibility, nor did I know that a vaccine would come in 8 months or 10 months, and nor did I know that this Russia-Ukraine conflict would happen. Forget 1 year ago, I didn't even know on Jan 31st that this was a possibility. So, to my mind, eventually the only way to deal with some of these risks are to go back to what I said at the beginning. How do you deal with uncertainty rather than how do you predict the event that causes uncertainty? It goes back to valuations, it goes back to diversification, it goes back to the kind of companies that you would choose to buy. So I think to my mind, that is the way you deal with volatility. You cannot problem solve. Right. So when you ask me about these questions, how will this inflation resolve itself? How will the pandemic resolve itself? Answer is I don't know. Right. I have a little bit of an optimistic view of the world that it will be a better place 1 year from now, it will be a better place 5 years from now. But can there be speed bumps along the way? Certainly there can be speed bumps. I have to wait for the point of time when my temperature drops to normal. Right? When temperature is above normal, you have paracetamol. When it drops to normal, you don't need paracetamol. Similarly, when valuations come down to what I would say is a comfort zone, don't worry about the risks. The risks are always there. Once the valuations are in your favor, the risks have been taken care of. That's the approach with which I have always approached investing. And therefore, I would not say try to solve these problems in your head. The smartest of economists have looked at all these problems and they will all come up with different answers. Just to sort of make a point over there, yesterday, US announced its GDP growth number, right? And everybody said, oh my God, it's a negative number, right? US is in recession. No, it's not. You have to look below those numbers to understand what's happening. It's actually a red hot economy. But the interesting thing is how come no economist actually forecast that such a thing would happen, right? Now, in hindsight, everything that they are saying is logical. That's why it was negative. But this they should have predicted in advance, but they couldn't. And that's the same thing that I would tell you. We can't predict how these things will resolve themselves. All we need to do is wait for the equation to come to our favor. When the valuations come to your favor, it works out to your advantage. If you don't know how to make things come to your favor, simple tools, diversification across asset classes, across different strategies, and finally SIPs, STPs to take the volatility out of the equation.
A very relevant point, and I think your answers are not correct only with respect to market, but a lot on the personal front also.
Sure.
So it's been very helpful, sir, and this session has been extremely enlightening for us. If I have to just summarize a few bullet points for our investors who have been watching this. First is that you started by saying that be careful what you wish for because you may get it, and it's extremely philosophical at times it sounds, but the way things have happened in the world, it has proved to be very, very correct. Second, and the most important point in terms of understanding market was that the only template or the one template which you should rely on for the market is not economic template, but it's a valuation template, which I think active fund managers like you always guide us in terms of how to navigate the market through. Third, and the very happy and cheerful note, which you mentioned that, if you want to be a citizen of any country in the world today, it has to be India, though it has no correlation with the market returns. And we do understand, sir, because historically in US also, if you see the data for the last 50 years, the correlation between GDP growth and the correlation between equity market is not very, very high. And after pandemic, we have seen that also, that big keeps on growing at the cost of small. And at the end of the day, economy may suffer, but big companies keep on becoming bigger. Bad news and cheap valuation are what an investor should look for. And at this point of time, you don't see too much of a pessimism in the market, and valuation on the large cap, you see to be moving towards a fair value, but you are maybe not very, very comfortable with the valuations of mid cap and small cap at this point of time. Lastly, you mentioned about how heterogeneity of opinion in the market makes market healthy. And I think in our language, we call it diversity makes any organization healthy. And that's something which is a takeaway for us from an organization building point of view also. So one key punch from your entire podcast, which I'll carry with me for a very long period of time, and which I'm sure investors would also carry, is that be like a fireman. And then you will have all the tools to handle volatility. And thank you so much, sir, for all these pearls of wisdom. And we really appreciate you taking time on a busy day. And it's going to really help our investors in a big way. Thank you so much for your time and your effort and taking all our questions in a very, very positive way. Thank you, sir.
Thank you, Harsh. Thank you, Megha. Next time you must call me to better weather in Bangalore and we can do it in person.